This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manassero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, I'm real excited about today's show. We have a returning guest. In fact, one of our favorite guests since we launched this podcast. I'm talking about Michael Becker. Michael Becker has been featured on numerous Old Dog episodes that we've had, and along with his co-host on Old Capital Podcast, Paul Beebles, who they did a thing on how to get bankers to love you. It was great, great episode. He has been affiliated with Old Capital Lending as a senior director of mortgage origination, but I think most of his efforts have been focused on SPI Advisory LLC. SPI Advisory LLC owns and manages over 6,000 plus apartment units in Texas, around $750 million in worth. When I first talked to Michael, he was just starting out, and just did a tremendous boost up to 3,000 units. I think we were, that was it was in 36 months when we first interviewed him. So he is still going gangbusters. He heads up SPI's Dallas office, where he oversees all aspects of property operations, including asset management, property management oversight, accounting and taxation, capital improvement and renovation projects, and investor relations. Over the last, last 7 years, he brought this portfolio up to 6,000 units. He's a lifelong resident of North Texas and a graduate of the University of North Texas with a BA in finance. He is married, has 2 young children, and maybe not so young anymore. It's been a few years. And he also co-hosts the Old Capital Podcast, one of my favorite podcasts. Well, Michael, welcome back to the Old Dogs REI Network.
Hey, Bill, thanks for having me back on. I appreciate it.
Yeah, well, you're probably getting close to the old dog status here. I don't know.
Yeah, getting older by the day. I feel it for sure.
Well, this is really great for me. It's it's good. I'd love to just kind of get updated and hear sort of what you've been doing, but I really do want to zero in on just the so to say the elephant in the room here. Just the impact of this COVID crisis and what that is really going to do to not only the multifamily market, real estate in general, but also on the lending side of things, because you have the expertise on both sides. And I think there's a lot of folks concerned in both. But if you wouldn't mind just kind of bringing us up to date, and I think the last time you were here, you're around 4,000 units. So maybe you can kind of just bring us up to par what's been happening since then.
Yeah, it's good you mentioned the bio. We today we own about 6,000 units. Should have been closer to 5. We had a few deals that were either in escrow or on the market that kind of got caught up in the COVID economic tidal wave that's kind of hit all of us. So, but yeah, we own about 6,000 units. In my career, we've done 10,000 plus. So we've gone full cycle on about 4,000 units. So it's been a heck of a good run. What I'm now calling the last cycle. So it was a great way. We about 7 years of it, and we certainly did more than most. So feel pretty fortunate to be kind of where we're at, and definitely appreciative of you having me come back on, and happy to talk about anything and everything COVID or non-COVID related.
Well, thank you, Michael. I appreciate it. You've been confined to home too, I guess, which is got to be an awkward thing for you. Used to working out of your office for so many years.
Yeah, having we have a second grader and a fourth grader. So having, my wife's a school teacher, so she's actually teaching classes from home as I'm trying to work. And we, both our kids are doing schoolwork all in the same place. So fortunately, we have a pretty large house at least. So we have some square footage to help a little bit, but it's, it's certainly a challenge when you're trying to get productive work done and having to remember how to do basic arithmetic and what an adjective means and some of these other little sayings that long ago.
That's great. Yeah. Well, it's I think it's got it's got its pluses and its negatives, but I think it's been great to see families together and be able to spend that time, especially dads too, because we're usually out and about, so it's probably been a treat for your kids, I'm sure. So you've been going gangbusters here. Were you sensing before the COVID crisis any kind of slowdown in the market, or I know certainly the cap rates have been getting compressed, especially in your neck of the woods there. What were you still finding the real steady deal flow, no problem?
Yeah, there was a ton of activity. So as far as like lending was full bore. There was robust and variety of different types of debt options out there, anywhere from, the agencies to bank debt to bridge, like debt funds that are bridge lenders to, life insurance companies, CMB. There's everything was available. There's an extreme amount of interest, an extreme amount of capital that was flowing into the multifamily space. I'm based in Texas, focus on Texas real estate. We were seeing a staggering amount of interest coming our way, and in the early part of the first quarter, the first 2 months, there was just an extremely high transaction volume going on, and we had a heck of a good first quarter in the first, really the first 6 weeks of the year, and we had, like I said, 2 deals in escrow, 1 on the market to sell. That was going to make it just over the moon, and then all of a sudden everything came to a screeching halt. So, there was it was certainly going to be the best year ever, really, if this didn't hit from a volume standpoint. Really there was no immediate signs of slowing down or anything like that, Bill. We were finding it harder to make sense of opportunity. So I think our transaction volume was starting to get a little bit spaced out, because it's getting just harder and harder to make deals make sense, just because, like, as you're saying, the prices people were paying were elevated, and the cap rates were getting low. So it was kind of making some of the returns get super skinny. So we were having a harder time doing quite as many transactions on the acquisition side. So we were in the process of selling some of the assets to take advantage of it, and then immediately overnight everything turned off.
Man, oh man. What's interesting is you've got both that lending aspect as well as the obviously the investor side of it too. But and on the lending side, has everybody just slammed on the brakes too?
Yeah.
Or wow.
Yeah, then that's what drove. Well, that's really what kind of drove all the transaction stopping, was the lenders. Just I always kind of like to use the faucet analogy when I'm talking about lending. So the faucet was completely full on, water's pouring out of it, money's pouring out of it, and overnight it would just like completely shut off. Right, it wasn't like a slow turn off. It was like all the way off. We, in the last recession, we had a period of several months where it started getting turned off. This was just abruptly and immediately. I think honestly, you probably point to when Tom Hanks got announced that he had COVID. Within a week of that, it was all the way off. The only real lenders out there right now of note. You have Fannie and Freddie are still out there loaning money to whatever transactions that may or may not go out. But with that said, they have a government mandate to go loan money. But what they are doing is, they're not giving any sort of policy exceptions to their credit policy, and additionally, they're layering in some overlays for credit enhancements, such as they're requiring 12 months of additional PITI reserves, so principal, interest, taxes, insurance, on top of the normal escrows. They're making you escrow 12 months of all those. So you're probably talking in most cases, somewhere between 5 and 7% of the loan balance up as additional escrows, which requires more money out of pocket. But the debt funds are out of the business. Lifeco, CMBS, most of the banks, all that money is just off for now. And it's simply because there's just so much uncertainty out in the marketplace. No one really has a sense of where this is going to go, how durable is the income stream, what are you going to collect, what are you going to have delinquent, you can't evict people, there's so much uncertainty that is kind of a wait and see approach right now from the lenders. And then I think if you throw a different asset class in, obviously hospitality or retail or just, impossible to transact on right now, just because of with anything with a loan on it, just because, what lender in the right mind would be putting money out in this environment?
Yeah, sure. I understand. Well, that's also got to impact, a lot of people's jobs, I would imagine, too, that are in banks, and that's got to be spreading pretty wide. I would think so.
Yeah, if you're a transactional lawyer, you work at a title company, you're an appraiser, all those things, there's going to be a lot less volume for some period of time. And then when it comes on, the faucet, it turns off quick and it's kind of slow to come back on. So be a couple of drops, hopefully, to maybe a small trickle of money coming out towards the end of the year. And then maybe next year we start getting, a little bit closer to, maybe several years ago levels next year as we start clearing some of these problems assets through the system.
Now, you mentioned agency debt. Now, are they mainly just finishing out deals that they already had under process, or they're still accepting new applications?
They'll still accept new applications if you have them, but there's very, very little to no transactions going on right now. I think the only transactions that you're going to see from an acquisition standpoint were most likely going to be, something that either was set pre-COVID that had, some hard money up, that is kind of finishing off, or maybe was almost set, had some sort of price adjustment, and then it's still gonna go, or potentially you might see somebody with a 1031 that needs to transact to avoid a very large tax hit. That'd be the only one I think out in the marketplace today that would be willing to buy in this environment of uncertainty until we start seeing a substantial price reset. We're in early May as we record this, May 5th, and what hasn't had time to happen is, anybody that was sort of kind of getting in trouble or basically in trouble pre-COVID, like in February and January, if you were kind of in trouble, this is a thing that's probably going to push you over the cliff and get you in trouble. But it takes some time for those deals to kind of recognize that they're just basically zombies walking around. So it takes a while for the bodies to kind of fall a little bit, so because right now the banks will give you forbearance, and then even if they didn't, the lenders can't foreclose because the courts are shut down. So it's going to take a period of many, many months for it to start. You start seeing some of the first deals kind of start flushing through the system. I'm hearing about this deal or that deal. These guys are in trouble and they're willing to take a haircut. But no, I really haven't heard of people willing to sell at or below debt balance yet. And for some of these deals that were over levered and just, poorly run and bad locations and bought for too much money, that's what it's going to take to clear some of these out. And then the guys that have, stable deals that are well run, that have proper debt on them, that, have some cash reserves. They'd be insane to try to sell an asset in this environment. So they're going to do what I did on the deals that blew up that we were trying to sell. We're just going to pull back, wait this thing out, and wait for a better time to go back out to market, whether that be in 2021 or 2023 or whatever we determine that it'll be. We're not gonna try to go upstream and sell something in this environment because we don't have a reason to sell because we're not We don't have a loan maturity, or we don't have some sort of distress within our operations. So the distressed deals will be the first ones to kind of clear, and anything that's not distressed, anything that's stabilized, I think anyone with a half a brain will just kind of wait for a better time.
Right. Now, are you guys at Old Capital dealing a lot with the forbearance applicants?
Like I said, I haven't seen too much or heard too much about it. I don't really do debt anymore, but just kind of talking with Paul every day and just kind of knowing what's going on, talking to our lenders. You've seen a handful of people apply, and everyone that applied had issues going into this, right? I mean, they weren't well capitalized. So I think we'll see more of those in May, because I think, generally speaking, April's collections were better than most people feared. Kind of if you would have talked to me in kind of that late March, I was thinking, oh my God, we're going to collect half our money or 70% of our money? What's going on? It was kind of the fears I had in the back of my mind. And the reality was, in our portfolio, at least, which is, Dallas and Austin based, and, generally a little bit nicer stuff at this point, we collected 97.5% of scheduled rent. So we had a 2.5% delinquent. And in any given month, in normal times, we're somewhere between 0.5% and 0.75% delinquent. So call it maybe 4 times the delinquency over a normal month. But, relative to where my fears were, this is much, much better than we all feared. And, we're kind of in the middle of May as we speak, so it's a little too early to tell. But, I'm thinking we probably close out somewhere, we'll deteriorate a little bit, but, 3.5%, 4%, maybe somewhere in that kind of range is kind of where I'm anticipating collections, our delinquencies to be when we close out May. And then June, it's too early to tell you what I think about June yet. But, so far as the residential real estate's holding up, I mean, if you owned an office building, if you, or you probably have some impact if you own a retail strip center, or God forbid, a hospitality hotel or something like that. I mean, you're going to have some pretty serious delinquency and pretty serious issues to contend with.
Yeah, that's those areas just been hit real hard. All of us are looking through the lens of, well, let's wait. Let's wait and see, But I mean, you've got this business to run. One thing I always impressed me with you too is you're very conservative in your investing. I always thought that was, I think you come at it from the banker, from the banker in you, right. To really, look at a deal that would appeal to a banker, right? So, which would tend to be more conservative. Yeah, at the same time, you've got to make projections. You've got to figure everything from staffing to what happens if there is this mass these rents that just don't come in. Are you sitting down and kind of, maybe in your Zoom calls with your team, looking at the various sort of worst case scenarios?
Yeah, we in March we modeled what we thought would be pretty conservative assumptions across the portfolio, and shocked it to see, okay, I think we had like somewhere in the mid 80s for April and 75% for May and June of economic occupancy. So between physical and economic loss, we'd be 25% of rent. And then that's kind of where we shocked it and see where we were from a liquidity standpoint. Could we survive that? Then kind of coming out of it, the second part of the year, that was our initial model. So we're in the process of remodeling now that we have April's data in hand. We'll kind of reshock each one of these assets. So, so far, like I said, I think we're all pleasantly surprised. I think we all fear, the longer we go into this, the more, payment issues we're going to have. I mean, seemingly the government is throwing the kitchen sink and then some at this from a monetary policy standpoint, keeping interest rates or taking interest rates to zero and printing, $3 trillion or there's some ungodly amount of money they're throwing at this. Here we're only, couple months into this thing, not even a couple months into this thing as we're talking right now. So there's going to be, seems like there's plenty more money coming behind it. So, I mean, I wouldn't be personally surprised if there's some sort of, national housing voucher for people in need at some point to kind of get on the backside of it. So I think we're fortunate where the government is recognizing that people need a place to live, and they're kind of putting moratorium on evictions. And if the residents can't pay us, then we can't pay our banks, and then the whole daisy chain implodes on itself. So I think going to do their best to kind of support people's ability to pay for the necessities, food and housing, kind of being 101A. So I feel pretty good that we're in housing. I would certainly hate to be in retail. So I think we'll probably come out of this generally better. One other thing or two other things that are kind of right now causing us continued headwinds too, which is in a bad time. But for the last several years, our property taxes keep going up and up and up, and Texas is a relatively large line item from an expense standpoint this year, typically your second largest expense item behind payroll. And so we just got our property tax notices out. And, they in Texas, they continue notices for, as of the January 1st of that year and then with a new assessment. And they came out swinging again with, pretty large increases. I think we're probably averaging almost 20% bumps in property tax valuations.
Wow.
And so where, they always start at high and you fight them down. But that's, there's no relief. No one just said, okay, let's keep it flat year over year because I know the landlords are in trouble right now. So that certainly wasn't a relief. And then the other thing that we're just in the process of is getting our insurance renewals. So insurance rates went up materially last year, and it looks like we're going to have at least a double-digit increase this year as well. So at the time where you have a little bit of uncertainty in your income, you're also getting your second and third largest expense item, at least for our deals, pop up and have some increases at the same time. So it is definitely a few challenges. So I guess we're going to certainly find out how conservative and how well structured I made all these deals over the last several years. They're going to be put to the test, But I think ultimately we're going to probably be fine. We're going to come out of this okay. I mean, I'm definitely more optimistic after seeing April's numbers and kind of the early indications for May now where they're coming in. That this as long as the tenants keep kind of paying rent, I think we can kind of weather the storm and come out the backside of this. And with all that money I'm talking about, with all the interest rate policies going to zero and appearing to stay at zero for the foreseeable future. I mean, Bill, I don't see any way that they don't create a tremendous amount of asset price inflation, right? I don't know if we see consumer price inflation, but I mean, I definitely think we'll see asset price inflation on things like real estate, for example. And so, I think the thing I've been saying here lately is I'm pretty sure, if you could just survive the next 12 months, the first year of this, you can make 10 years, and then 10 years, I think we're going to see materially higher prices, like somewhere around, triple, I think, of what the pre-COVID peak was. That's where I'm kind of anticipating, generic multifamily prices go in 2030 because they're just throwing trillions and trillions and trillions of dollars while they keep rates extremely low. So, I was born in the decade, but I'm kind of thinking this might be almost like the 1970s, maybe without quite the consumer price inflation. But who knows, right? I mean, they're printing so much money; it's hard to know exactly what the effects are. But if you look at price of everything in the 70s, as I'm sure you well remember, dramatically increased, and real estate prices, especially in California, tripled in the decade. So I think every year it'll be a little bit different, but I think that you have that as a real possible outcome when you come out of it. So can you make the next year? If you can make the next year, I think you hold on, and your real estate, at least in nominal terms, be worth a whole lot more. I don't know how much on an adjusted inflation adjusted basis it'll be worth. They're certainly going to have to debase the dollar by their monetary policy. So I think we're in tune to see quite a bit of real estate price inflation over the next decade for sure.
Well, with the Fed and the sort of the national legislation and so forth that's going to come out of this thing. There's also the sort of the role of the states too. Do you feel, is there an advantage to being in Texas as opposed to other states of the union?
No doubt, right? I mean, and we've been seeing what I kind of been calling an economic migration for the better part of the last couple of decades, right? I mean, I think in the overly regulated high tax states where you're a resident of, for example, California or New York or Connecticut or Jersey, all those people are moving to Arizona, Florida, and Texas, right? I mean, that's kind of where a lot of the population is moving. So it's a little bit more, certainly tax advantaged, and we don't quite have the regulations. I think what California this year enacted, or last year, if we're in effect this year, national rent control, the second state in the country to do that, and then I think. I read an article here recently that the city of Santa Monica, that any resident that is delinquent on their rent now has 12 months to bring it current.
Yes.
Like stuff like that, right? I mean, it's like, it's just like, how can you put your capital at risk in an environment like that? Doesn't make sense. So capital is going to flee, and then jobs are going to flee that. And then, as I think one of the things everyone's anticipating as, kind of a long-term change economically, is we're going to see a lot of, I think we realize that our economy, and in particular the supply chain, was extremely efficient for many decades, but it wasn't very resilient. So I think we're going to start seeing a bunch of the onshoring of jobs from, Asia and China specifically back to the United States for things, certainly like critical things like, our drugs, medicine, and things like that. And I couldn't envision any company voluntarily putting manufacturing jobs in a place like California. Those jobs are going to go to like places like, Arizona, Florida, Texas, or, several other states that have similar type of economic policies. So I think there'll be disproportionate winners. And, I think the states that are generally high tax, high regulation, hard tenant landlord laws, or, at least from the landlord's favor, that are disadvantaged. I think those states are going to perform a little bit worse, and the states that are, a little bit more business and landlord friendly should generally continue the economic immigration that they've been seeing for, a couple of decades at this point.
Now, you mentioned earlier about the property taxes in Texas. Definitely a little higher than other states. It's because you're like a no income tax state, so that's kind of where they're making up the gap there. But do you foresee or get any rumblings that that some of those states that may not have that, as they're having trouble getting maybe the amount that they want for property tax, might introduce some sort of a personal income tax?
I can't envision any time in the near future that would be in Texas. I think that's a lot of people that are moving here, even if they have different politics than the people who historically have been here for a while. I think that everyone agrees that having a no state income tax is really very beneficial. So I think, obviously, the states are going to be hurting quite a bit. The states that are already in trouble, like in New York, like Illinois, I mean, those states are, going to have further exacerbated issues due to their revenues, plummeting from sales tax and property transfer tax and this types of tax, all the various taxes that the Illinois and places like that had. So I'm not quite sure how they're gonna solve it. I think they might ultimately have to cut some of their spending, maybe renege on some of the pensions, because their pensions have dramatic unfunded liabilities, and these have been ongoing issues. Listen, I think one of the things I listen to a lot of podcasts. One of the ones I like is a guy named Jason Hartman, and he always says that economics is a relative game, right? So if we're all getting poor, but you're getting poor at a faster pace than me, then I'm definitely winning relative to you, right? So I think that is certainly something from a state standpoint where I think, again, people are just going to continue to migrate away from places like Chicago and New York and some of these really high tax places, and all those people that retire in Florida or Arizona, right? And they're gonna go for sunshine and low cost of living.
Great feedback there. Yeah, I think one of the things that we represent. People listen to the show. There's some of them are. They're very modest investors. Maybe they got a duplex or quad somewhere. Then you've got those that are buying apartment buildings, and then you've got those that are the passive investors that are investing in the syndications. And if you would, just for a moment, from your standpoint, because you're an investor, and I think you've been in all those spaces at some time or another. What would be the advice that you would say, and it may just be, cautionary things, but what would you advise the investor right now to do? The things that they just absolutely should do, point blank, first off, and then what other areas might be 5 things, might be 10 things, I don't know, that every investor should be doing at this time?
I mean, I think the first things we did was, which is kind of already past at this point, but make sure that life and safety and health of your staff and your on-site residents and things like that are taken care of by shutting down the common areas and things like that. Now we're actually starting to have some discussions about, hey, when do we open those up? Because we're starting to kind of see the light at the end of the tunnel a little bit. That was the first thing we did. The second thing we did is we try to conserve as much cash as possible. So we, to the extent we always paid monthly distributions, we turned all those off and started holding some cash, as well as we're not doing any sort of voluntary upgrades, just kind of basic make keep and basic turnovers. And we're not really upgrading the units because I'm not quite sure what demand is going to be out there. And then the demand that's out there is probably going to be a little bit even more price conscious than historically. So if I had a property that had a programmatic renovation program where I go in and swap out flooring and appliances and fixtures and then try to go get $100 additional rent bump by having a nicer unit, I think the demand is most likely to take the less a clean unit but not an upgraded unit and save the $100 a month. So we're going to offer more classics there. So do your best to kind of hoard cash, and then I think as far as everything else goes, I think more communication is better than not. So if to the extent you have other stakeholders, one of the things that I did today, and I do multiple times a week for the last couple of months, is I'm communicating weekly or a couple times a week with all my investors, kind of collection progress, because that's what the only thing that really truly matters right now is getting dollars in the door. So and everyone that's invested with us have the same questions and thoughts that I have is how our collection is going. So I'm trying to make sure I communicate as much as possible. So with both my investors as well as my lenders. So to the extent that you have other stakeholders that you're involved with, more communication is better. Bad news doesn't age very well. So I think, if you have some issues and you sit on them, they're not going to get better with time, and they're not going to be better received 30 days later. So try to make sure you just kind of communicate that. And then I think from there, we're just trying to, like I say, if you're going to get yourself in a position to survive the first year, I think in 10 years from now, we're going to see a hell of a lot higher prices. So if you can, the best of your ability, get yourself in a position to have your liquidity set aside, to get yourself educated if you're not fully educated, to make sure you either establish new or maintain existing broker relationships. So when the deal flow starts getting turned back on, you're going to be in a position, have relationships, and be all set up to go take advantage of it. So those are things that we're trying to get both from a defensive and hopefully soon an offensive standpoint.
From the debt perspective, granted, you've got different types of loans and probably a lot of agency loans, but are there any, is there any consideration of looking at, new terms, trying to negotiate new terms, or with rates so low, refinancing or anything like that can help reduce your expenses?
So we were fortunate where we just refinanced two deals. One closed in December, one closed in late January.
Oh, that's great.
And so that was good timing that we went to adjustable rate mortgages on all those. And so then the rates are, even materially lower because all the indexes lower their rates. So that was fortunate. We had one of the deals that we had in escrow that fell out. We had was the only loan I had recourse on. So it was a relatively small deal that my partner and I own ourselves without an investor. So we actually took over the Freddie Mac small balance loan that the buyer was going to put on it. We took that over. We actually just got approved today, so we're going to go ahead and refinance that and get a little bit of cash out. And they're going to put 12 months of reserves on us, like I mentioned earlier, which is okay because it's coming out of loan proceeds, and that makes sure that deal is never going to have a problem because we have so much capital set aside. And then I think we did have one or two that we were going to try to refinance. One we were debating whether to go early in the year or wait until our prepay burns down, and I think it's August, goes to zero on this deal. So hopefully we'll refinance that one, and we have another one that we're hoping to refinance. So as soon as I think the world opens up a little bit, I just don't want to go fight upstream right now. I think the lenders just need to get a little bit of collection data in the rearview mirror, and I'm hopeful by the fourth quarter we get somewhere closer to what it was to start the year out. as far as debt terms and structures. I don't think we get all the way back to where it was, but I think there's a couple deals that we still have, two or so years left on a bridge loan with a couple extension options, and we're going to try to get those into a little bit longer term deals, and because we basically implemented our value add strategy, so now it's time to go refinance the deals out. So hopefully we get a couple refinances out this year into a little bit more favorable terms and kick the maturity can down the road, 5 to 7 years at minimum.
Do you think, you mentioned variable rate loans. Do you think there's going to be sort of a resurgence, and at least in the single family, the residential area of those types of loans again?
I'm not so sure on the single family, because the thing that the single family certainly has always had an advantage of the multifamily on the debt was you could take a 30-year fixed rate loan, which is next to impossible, with the exception of getting a FHFA or HUD loan on a multifamily deal. All these loans typically have a call, mostly in like 10 years. This is a pretty typical maturity. So one, having a 30-year fully fixed loan is advantage on the single family side. But the other biggest thing is there's no prepay penalties typically in the single family space, where in the commercial space they have either yield maintenance or defeasance prepays, which could be exceedingly expensive, very, very material. So having long-term fixed rate on commercial deals can be prohibitive when it comes time to sell a deal. So I think if you miss on a single family, you lock a deal at 5% and the rates fall to 4%, you can always just refinance it for just transaction costs without a prepay. Well, if you have a commercial loan at 5% and rates go to 4%, and you want to refinance it with 8 years left, you can have a substantial prepayment penalty on top of transaction cost. So I think it typically makes a little more sense on the commercial side to float, as well as there's like derivatives. You can buy interest rate caps where your rate can never go over a certain amount, and those are really inexpensive right now because the entire market is pricing in rates that are basically going to go to next to zero and stay there for the foreseeable future. So I think to the extent you can get it with a reasonable spread, which the spreads have widened, the credit spreads, so the spread over the index, over LIBOR or Prime or whatever your index is, widened out or expanded out over the last couple of months as people were just trying to slow lending down. I think those are starting to come back into a little closer to what they were to kind of begin the year. So if you get a good spread and a low index, I think that just rate mortgages make some sense if your time horizon is kind of in that medium term from 2, 3, 4 years. I think those make a whole lot of sense right now versus trying to fix something for 10 years. But that can always change.
Do you see the Fed being a lot more lenient than in the past in terms of things like 1031 exchanges, or maybe holding back on calling loans, maybe allowing some grace there? What's your feel for what's going on there?
Yeah, I think for sure out of the gate with the agencies, they're basically both announced that you got to qualify for it, but they'll give you 90 days of loan payment forbearance out of the gate. So that was certainly different than last time. That was pretty much just from the word go, they gave you that. And then as far as 1031, they did allow, if you're in an identification period, they allowed you to go all the way till the 15th of July, I believe it was. So they did allow additional time to go out and identify, because people if you had to identify a deal, last month, it'd be very challenging to identify everything because everything that was for sale kind of got pulled off the market. So they did give you a little bit more leniency from that standpoint. So yeah, I think generally speaking, the Federal Reserve and the U.S. government in all forms of fashion are going to try to be extremely accommodative to support every aspect of the economy and the system, and then we'll see what short-term benefits you have, and then how bad the long-term repercussions will be from all these policies. I don't know, but it'll be interesting to see how it plays out.
Yeah, you got that. Well, I know I've already kind of kept you a little bit longer than I said I would, but I wanted to ask you if there were sort of any closing things you think might be helpful for our listeners, and just maybe it could be in general, or it could be specific to the crisis here.
Yeah, I think really the first thing you guys need to do if you're starting to get into this business and real estate investing in general, just kind of get educated. So listening to Bill and podcasts like this, I think are a good first resource. And from there, it's if you want to get in and really grow in this business, it's a relationship business. So it's going to be interesting to see how the new world is going to cause some benefits and challenges by not being able to leave your home to go get networked with brokers, or if you're a passive investor, learn, get relationships with people that are sponsors of deals, et cetera. So it'll be, got to get out, got to get network, got to get to know people. The only thing that's guaranteed is things that are the way they are today will be different in the future, and there's always change. So just trying to make sure you stay on top of the evolving market and stay as knowledgeable as possible. Those are some of the things that I think will allow you to react the best and make great decisions.
Well, thanks so much, Mike. I'll tell you, it's great having you on. I think you're good, definitely a good voice for those that are listening. I think you're the way that you've approached things since you started have been something that are going to benefit you, especially in these tough times. Because, right, we all kept saying, yeah, we know there's a recession coming, we know something's happening, right? And but you were very much structuring your approach to anticipate things like that, which is great. Well, I'm sure there's folks that are listening too that would like to just find out more about you and SPI, and what's sort of the best way for folks to learn more about what you guys do and so forth.
It really is two ways. One is, as you mentioned, I'm the co-host of the Old Capital Real Estate Investing podcast, so you can find that on iTunes or Stitcher, or probably anywhere you're hearing my voice right now. You can go there and just type in Old Capital and you'll find our podcast, or our website is oldcapitalpodcast.com, or the company that I run and operate is SPI Advisory. And simply go to our company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us form. Fill that out, and I'm always happy to set up a 10 or 15 minute call with people I meet off of podcasts.
Awesome, that's great. Well, thank you so much for taking the time and in the midst of this craziness right now, just to be able to share with our listeners and be able to provide some wisdom here that, especially those that are kind of looking at their investments and what's ahead here. I think overall, you have an encouraging message, and I tend to lean toward that direction too. I think things can turn around pretty quickly, and so far, we've kind of seen that happen just in dealing with the crisis itself. So, thank you for being with us. And Mike, you know the drill here. You got to give us a good old hound dog howl. I mean, are your podcast and mine? One of the few that have that old first word in it. So you can just give us an old hound dog howl.
Maybe my wife's gonna think I'm crazy here, but ow, ow, ow.
Right. All right, Mike. Well, thank you. I appreciate it, and we'll stay in touch. I'd love to have you back again, and maybe we can talk about how great things are and all the great opportunities. So I'm hoping that show is going to come up.
Thanks, Bill. Appreciate it.
You bet. Well, thank you. And I just want to thank all of our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything that Mike talked about today will be outlined in our show notes, and there'll also be links to his website and the information that he mentioned as well. So that's the show for today. Remember, cash flow is king, and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dog's REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.